Have you ever wondered why people or you sometimes make strange financial decisions? Like buying something you don't need just because it's on sale, or following the crowd to invest in something you don't understand? Well, all these bizarre behaviors can be explained by behavioral finance, where psychology meets money. Behavioral finance overthrows the assumption of traditional finance, which holds an assumption that all individuals are rational actors. It is a study of how emotions, biases, and social pressure influence the way we spend, save, and invest. You might think you always make logical financial decisions, but that's not always true. We are humans and we are wired to be influenced by our emotions and social environment. So now, let's get into some examples of behavioral finance. First up, anchoring bias. Imagine you saw a price tag on a jacket saying $90, but there's a discount and it's now $50. Your brain immediately says, it's such a great deal, even if the jacket's true value may only be $30. The $90 here serves as an anchor, which is the first piece of information encountered. This acts as an initial referencing point and influences the decision of your purchase, even when the $90 is totally irrelevant to the jacket. Next, emotional gap, where decisions are driven by emotions such as fear, anxiety, or greed. Such emotions often halt our critical thinking and lead us to irrational financial decisions. What would you do when one of your investments in the stock market falls in price? Do you panic and sell them all at once before losing more? What if the stock price rebounded after a week? Looking back, the decision to sell the stock is only based on one emotion: fear. If more research had been conducted, would the decision be different and lead to a reduced loss? Maybe. So why not think twice before being led away by your emotions? Now, let's say you get $50 cash as a gift from your friend. You're excited and spend it all on snacks and games. But when it comes to using your own savings for the same purchase, you hesitate. This is because your brain treats the gift money different from your saved money, even though they are worth entirely the same. This mental accounting can lead us to making inconsistent decisions which could possibly affect our financial planning. So, how is behavioral finance used by companies to maximize their profits? Flash sales at the end of seasons or hourly flash sales that provides huge discounts within a 1-hour window creates urgency to make us buy quickly without thinking, as you're anxious about losing the discounts after the sale ends. And limited time offers are designed to trigger our fear of missing out, or FOMO, so that you can tell yourself you're losing something if you miss the offers, when in fact you don't. So how do you avoid from falling into such traps? A slight pause before any purchase will give time for our brain to think rationally and make the best decision for us. Always do thorough research before following a trend, especially for investment made. And stick to your own budget, instead of letting the flashy deals tempt you into overspending. Behavioral finance teaches us that our brain does not always react logically when it comes to money. But by spotting these biases, the chance of you being a rational actor in the market increase. So next time, remember to think twice before making any financial decisions.